Hello guys, welcome to Trade with Raymond. Today I am discussing stop losses. Trading without a stop is dangerous. However, it's been advocated by some traders and teachers that it is okay to have a trade without a stop loss. That is quite challenging because your funds are not endless. Your funds are finite and the market can take out any amount of money you have. Remember, it's a $6 trillion market, and no matter how much you have, it's so easy for the market to take it out. So, how do you determine a good stop loss? Now, some people may look at the swing low, swing high as their method of determining their stop losses. Some people will use the ATR, the average true range, which is a very quantitative driven way of determining stop losses. It's an effective stop loss determinant. I have used that for many years. It has a few weaknesses, but it's not a big deal because it's one of the best tools or best ways of determining your stop. We also have an ichimoku way of determining stop losses. That's what I call blue means stop. There's a wonderful way Ichimoku looks at volatility and determines how you can plan your stop around market volatility so that your stop is good and surefire so the market hardly takes out your stop. And I'm going to look at in this series, in this master series, particularly this video, I'm going to look at how some people determine their stop losses and how ATR, which is a very good tool that I have used for many years, is used, and how when you're trading Ichimoku, you have to place your stop based on how Ichimoku itself has within its ecosystem, its agile system, how stops are developed or how stops are placed. So guys, watch this video, watch it carefully, watch it over and over again, because you're going to get a lesson that you cannot get anywhere when it comes to Ichimoku trading. So thank you very much. Subscribe while we get into the chart, start sharing, start adding your comments, and see you on the chart to see how we place surefire good stops. See you there.
I mentioned the ATR, and this is the ATR. Default is 14. I use a 20 based on back testing several years of using the ATR. It's the average true range. It's found on all charting packages and it's very easy to use. For example, I go to the daily chart, let me zoom in a bit. So the information I'm getting here with the ATR means that the market on the average has been doing 111 pips, sometimes 110, and so it's just around 110 pips movement on each day. I mean, some days are different, like the very big move here, right? So every time you approach your chart, especially if you are trading intraday time frames, you need to go to the daily time frame and look at the last but one candle, or you can even strike an average between the last 3 days and the last 2 days and do an average of that and use that to determine the market movement in terms of how many pips you expect the market to move. Now, it's important to have realistic targets. Usually when people measure the ATR, they want to the entire ATR to be their target. For example, it is expected that the market is expected to move last 2 days. The market was expected to move 112 pips. Somebody will want to target the entire 112 pips as their target. That's wrong. And yesterday was expected to go 111 pips, or somebody also expect that they would have made such number of pips. No. What happens is that the market only trends 25 to 30% of the time. It means that about 70% of the time, the market is not trending. The market is ranging. All right. So as a trader, this information is very important. Most people do not understand this, and therefore they expect the market to trend every day. They expect the market to go up regularly, down regularly. They do not expect any choppy moves, and therefore the targets they put on their trades are really unrealistic. So looking at this, coming to the 110 pips thing, coming to the daily time frame, the hourly time frame, if you measure from down to up, looking at the average, the market moved about 110. So the market projected an 110 pip movement. It did 102 pip, which is wonderful, which is very close. So as a trader, if you get into a position, you should be targeting somewhere around 25% of the ATR. That means that, let's assume it's just 100. So 25 pips is your stop loss. That is how you determine your stop. Not to say, okay, I'm going to put my stop at the swing low. This is my stop, and that's how I trade it. This is my This my, let me move it here too, and this is my stop. No, that approach is really wrong. You'll be putting your stop at the wrong places and you'll be losing heavily. Also, you can also put your stop so close, and then the next day the market hits you and you're out of the trade. Some people also say, well, I'm looking for a round number. If I can find a round number somewhere here, that will be my stop. Right. Round number theory has been used for a long time. Now, it doesn't work over time because the market doesn't respect your round number. The market is a $6 trillion market. It doesn't respect your round number because that's how it is. I mean, you should have a proper way of determining your stop. So a volatility filter like the ATR helps you to determine your stops properly. It's a very powerful tool for stop determination. Now, we have the let me talk about the slightly higher time frame. For example, the 4-hour time frame. Would it be wise to derive your target from the daily time frame? No, that would be wrong because in just 4 candles the day will be over. So by technical analysis, you should move to the weekly time frame. And so on the weekly time frame, the market is expected to move somewhere around 100, let's say 180 pips for simplicity of calculations. And then so a trader who takes a trade on the 4-hour time frame should be looking at a quarter of that as their target, somewhere around 55 pips thereabout. I mean, if my calculation is correct. And a trader who's trading the daily time frame must filter their volatility from the monthly time frame. This is how it works. So anybody trading anything 1 hour and lower should look at their ATR from the daily time frame, and this will help them to determine what their stop should be, and a quarter of that must be your stop loss. A quarter of that must be your stop loss. The reason is that the market only trends 25 to 30% of the time, and therefore looking at higher targets or putting your stop so close will mean that you'll be hit. And so that is why we look at the stop just around 25% of the ATR. It also means that those who are using ATR as their target, 30% of the ATR will be their target because the market trends only 30% of the time. So if it's trending only 30% of the time and you have a volatility filter that is giving you 100 pips and you want 70 or 80 pips, I mean, you may not get that. Once in a while you may get that, but realistically the market will not do that and come back to hit your stop. So your stop must be 25% of the ATR. Your target must be somewhere around 30% of the ATR because of the behavior of the market. And that applies to anybody trading from hourly to lower. If you come to the 4-hour time frame, the daily time frame, some few things change. Where you target just changes. So I'm reiterating so that you would understand this method properly. So if you're trading the weekly time frame, your volatility filter calculations must come from the weekly if you're trading the 4-hour time frame, and if you're trading directly from the daily time frame, you must filter by the monthly. So if it is a huge time frame, that is the market is expected to move somewhere about 578 pips. Let's say market is expected to move about 580 pips for the entire month. So if you take a trade on the daily time frame, this is a long-term trade, you need 25% of that. So if the market is expected to move 580 pips, so you should be targeting 145 pips on this position. Doesn't mean that after you've made the trade, when another opportunity shows up, you will not take. You should take it again because the market can reset, come back to that low, and start all over again. So that is how we treat the ATR. Now we come to the almighty ichimoku. In ichimoku, blue means stop. Blue means stop here. All right. So our stops are going to be determined by where the blue line is. So for example, if we go into the market somewhere here, okay, our stop loss is just behind the blue line. Is this arbitrary? No, because this is a 26 moving average. It's a mean of a mean. If you go back to my earlier moving average explanation between that of the ichimoku and the traditional moving average, it was clear in that video how this is derived. And so based on that, our stop is behind it. Some ichimoku traders may want to use the base of the cloud. That's a bit too far. All right. So using the base, or that's why we call that the baseline, using the base of the tool Okay, the base of the moving average is the best way of determining. It doesn't matter the time frame you are on. We'll be looking at multiple time frame analysis in our next lesson. It doesn't matter the time frame, and then how to target. So ichimoku is a trend following tool, and so if you capture a market, you need to give it ample room. So the stop is always behind the blue line, assuming that we took our trade. Let me color this area somewhere here. Okay, we had a sell trade somewhere. Our stop would just be above the blue line. Okay, the opposite of what we said here. This is how ichimoku is traded. So even if you go to, let's say, another time frame, it's the same way. Blue means stop. So if you are looking at a buy trade and then you happen to get into the market, all you need to look at is where you got in the market. Where is the blue line underneath that candle? Underneath that candle, where is the blue line? That blue line, you give it a space of about 2 pips, and then that is fine. That will be your stop loss. And then you enter the position. And it's a very robust stop loss because of how ichimoku is designed. Very robust. So guys, listen to this lesson. Go over and over again. Like, share, make comments, send me an email, send me a text. Get further explanations if you need some, and I'll give it to you. And then follow us. Click the bell icon, and in a matter of a few weeks, you'll be a master ichimoku trader, and you'll be profitable regularly. Thank you very much, and see you soon.